You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listeners. And next up is an old friend of the network, even though he has been on a little bit. He is Jon Cherry, the global head of U.S. options over there at Northern Trust. Jon, welcome back to the program, sir.
Great to be here, Mark, in sunny Florida.
Yeah, I should mention, if I sound a little bit different, listeners, I'm not coming to you from our studio in Chicago. I'm actually coming to you from the CBOE Risk Management Conference here in scenic and sunny and very volatile Florida. So it's a good time, Jon, to be talking about equity volatility. And I happened to bump into you at a conference like this. So what is it that brings you down to the world of equity volatility, sir?
Well, the CBOE's Risk Management Conference here every other year in Bonita Springs, and big supporter of the annual conference. Here, see a lot of the speakers and catch up with some friends.
Speaking of catching up, it's been a little while since we've had you on the network, probably about a year, if not longer. So I'm sure a lot has been happening in your neck of the woods as you're kind of growing the options business over there at Northern Trust, speaking to clients, hearing what their needs are. So walk us through, maybe let's start at the tail end of last year, kind of what you were seeing from a client demand and options use case perspective going into the end of the year as we were marking, the end of the year, the end of a decade from an options perspective. Then coming into this year, now obviously we've seen a wee bit of turmoil. The year started with effectively assassinating an Iranian general and went downhill from there very quickly. So we've seen quite a few drivers for volatility. I know a lot of your clients come from the kind of more broad equity and even the fixed income perspective. So a little bit different clientele than maybe we're used to talking about in the options side here. So walk us through it, what you've been seeing there as well in terms of recently as they're responding and what you've been seeing from a client demand perspective as the volatility is ratcheting up.
Yeah, sure. So as you may recall, a lot of our clients that we have on the options platform are asset owners, asset managers, anything from family offices to ultra high net worth individuals, 40 Act funds, and hedge funds. And so going into the late fourth quarter last year, a lot of celebrating a lot of gains that we've seen within the S&P complex, but then really looking to be proactive by nature and looking to put on tactical hedges on the S&P and some of the VIX complex as well, positioned for some level of pullback. I really don't think the anticipation was to have it hit early first quarter, but to then have the typical duration that we were seeing was kind of that 45 to 60 day. Nothing too out of the ordinary when you're putting on that type of protection.
But there was an appetite for that, because usually, obviously, the argument against that is I don't want to pay for this. But toward the end of the year, they were starting to be willing. They had enough gains. They were starting to be a little bit willing to pay for a few months worth of protection, which in and of itself, I think, is worthy of note. Indeed,
yeah. So to burn a couple hundred basis points to put on that level of protection when you're buying kind of the low teen, mid-teen implied volatility was something that customers were directionally in favor of.
By the way, you mentioned that kind of couple hundred basis points. We get asked this question. You might have even discussed this in the past. I'm not sure. We get asked all the time. And people come in and they say, I'm looking to hedge my portfolio. It could be S&P, could be whatever. They're worried about some near-term downside event. How much should I be willing to spend for, a reasonable amount of protection, like, let's say 3 to 5% out of the money. Let's go a couple of months out maybe. And I usually throw out that ballpark percentage of like 2, maybe 3%, depending on how you configure it. That's kind of where we come down. I'm curious for you, what do you think that answer would be if someone asked you, how much should I reasonably expect to spend? Obviously, not this week, because we're in a weird week right now. It'd be 50%. But outside of these aberrant scenarios, what's your usual kind of go-to ballpark percentage?
Sure, I live very much in your camp, kind of that 2 to 3, even 350 basis points level of explicit spend. But it's funny, I'm sure you've seen throughout your career when you're in a lot of these conversations with clients, even that number tends to be a little bit like, I don't know if I really want to spend that. By and large, some of the conversations that we would have is, that all sounds well and good, but I don't want to pay for it explicitly. So are there other scenarios out there, strategies out there that are maybe explicitly less cheap? We kind of strive by the model of keep it simple. And, if the opportunity or the objective is I really just want to, capital preserve my portfolio or my single stock or my exposure, buying a put or a put spread makes the most sense.
So they come to you, you show them an at-the-money put. They say, that looks cool. Oh, wait, how much does that cost? Oh, listen, they end up with a 30% out-of-the-money put spread with like a collar against it to pay for all of it. And
exactly.
That's what happens when they realize they have to pay for that stuff. But let's fast forward to, obviously, we're in an interesting time in the market right now. I'm sure when you're not talking to me right now, you're on the phone probably dealing with clients and all their various inquiries right now. What kind of stuff are you hearing? Are people deleveraging? Are they looking to maybe even more aggressively hedge right now? What kind of stuff are you seeing from the client side right now?
Kind of across the gamut. It's a really good question. So last week was, oh my gosh, do you see what's going on? And a little bit more of that this week with the sharp snapback yesterday. But it's really kind of all over the spectrum. We have a lot from a northern standpoint. We have more clients coming in, so the phones are ringing a little bit more. The emails are coming a little bit quicker to set up conversations, to have meetings and things like that. From an active or tactical trading standpoint, kind of your regular customers are coming in more frequently and more often because there is more opportunity out there. But, for some of us veterans that have been around for a long time, these are markets that we've kind of been waiting for a really long time. And so I'm kind of the camp where, we can't ask for volatility and then kind of shy away when it actually does happen. And so I kind of welcome this type of environment. Having some level of, consistency and certainty around what is going on, I think we can certainly support. But, just looking at today, like the big surprise of the Fed coming out and doing a 50 basis point cut, kind of out of nowhere, even though it was kind of rumored that that Fed was going to be on the sidelines to step in, I do think is really putting another wrinkle into the market.
Are your clients starting to say, hey, we're thinking about maybe nibbling, maybe some short put spreads or things to get back in? Or are they still very much waiting to see how all this volatility maybe has to die down a little bit first before they start diving back in?
For kind of our normal systematic clients, it is still business as usual. But yes, for some of the more tactical, it's let's kind of wait and see, be patient, keep me up, so more proactive engagement, et cetera. With it coming into early March, where earnings are right around the corner in the next 30 days, and I think that is going to be a big tell as well to see if we're starting to see some of the effects of the things that are going on globally.
Yeah, we'll see the first real hits of whether the demand annihilation across the board. We always see earnings season is pretty much excuse season. Right? Everyone uses it to blame for whatever the ills are. They're going to find something to blame. I got a feeling a lot of them are going to be blamed. Even things that have nothing to do with anything coronavirus related are going to be blaming.
Well, even on that point, Fed cutting the rates by 50 basis points, I think is great for credit. And so, is this really a credit issue, or how is this even going to affect the overall equity market? So I don't really see how cutting rates affect supply chain, et cetera. I don't totally understand the correlation. And so I'm, of the camp that there's really no reason to stay higher. So we'll wait and see.
Were you, like a lot of our contributors over the last week, starting to look at the term structure out there of volatility and say, wow, the VIX cash is closing in on 50 and the futures were what, 26? 27?
Exactly.
It was a strange scenario, to say the least. Was that one that kind of caught your eye as well?
That's exactly right. I had sent out a kind of an internal note saying, hey, check out this kind of not real anomaly, but like, here's what's going on.
It certainly is, right? Something had to change. They both could not stay there. The cash can't stay there. The futures, they have to somehow meet in the middle or something along. I think you probably could argue the cash couldn't really come down too much given what we were seeing. So the futures had to go somewhere.
To catch up, yep.
I think they mentioned on one of the panels today, they're pacing in a little bit more rapid normalization of volatility. I mean, that's the technical term.
That's right.
Versus,
and on that note, I definitely want to hire Annie Duke.
Speaking of that, have you seen,
Yeah.
I know we've been busy here doing things, but have any presentations or any studies or any kind of volatility conversations really caught your eye here at the conference this year?
Big fan of the Russell, the first one that we kicked off yesterday. I really like that. We use it. Some of our clients are engaged in that as well, and so we'll execute on their behalf in those markets. There was the big part of that was liquidity, and I absolutely think there is deep pockets of liquidity there. Just like any other index, it's important to understand how to trade them, how to think about them, and be able to source.
Are you getting a lot of
properly.
client demand for small cap?
It's growing. It's nowhere near what we have in kind of the S&P, but it's definitely growing. I mean, it's
hard to argue
there.
against. We just had Sean on for TWIFO not too long ago, and it's hard to argue against the volatility story for
That's
Russell
right.
2000. And plus, we are in kind of a weird environment because the narrative has always been small cap is somewhat insulated from these macro shocks, and yet it's been leading the market to the downside for the last couple of weeks. So
I agree.
Clearly not insulated, and also an interesting volatility story. I've been trying to get the SIBO to bring back their Russell 2000 volatility product, their VIX RVX, for quite some time. Maybe these last couple of weeks will give them a little bit more ammunition to finally bring that back so you can trade a pure volatility play out there in Russell 2000. One of the other things that caught my eye at the conference this week, we've been talking a lot on our volatility program and other shows, also on the advisor show, about the interesting nature of not just where the cash and the futures are right now, but just in general, the interesting nature of the volatility term structure for 2020. We saw over the last month or so, a very prominent blip around the election. And that's not surprising because obviously the election is a point of uncertainty. But I think the degree of that, how much vol they were pricing in was certainly could be debated. But a lot of people have been writing into us lately saying, how much of this recent sell-off do you think is coronavirus related and how much is it perhaps the domestic political scene driven as well? And that's obviously an impossible question to answer. But a panelist, I think it was the Goldman researcher yesterday, made an interesting point because he specifically highlighted that portion of the term structure and said, you know what, if this was entirely coronavirus driven, this premium wouldn't have expanded, yet it expanded markedly over the course of the sell-off. So clearly some element, what portion I don't know, but some element of this is driven by other factors outside of the corona, which I thought was kind of a fascinating development and one I'm sure we'll sink our teeth into more here on the network this week and indeed on volatility views. But I'm curious, what else is lighting up your tape over there at Northern these days other than talking clients off the ledge when you're not talking to me?
Sure. So, we're continuing to grow as a team. We're adding both personnel and investment in technology to help further satisfy the client experience. From a volume standpoint, 2019, even though it seems so long ago, we had a record year both in volume and in new client opportunity, and so we're still continuing to plug away. Most of our clients, where we're seeing the growth from, is from the asset owner space, the true foundation and endowment space. And so how we're really trying to really enhance that captive audience is with education to those investors about positive use of option-based strategies, either working with us directly or through third-party managers, and really just trying to pound the pavement.
Yeah, you're in an interesting position compared to a lot of the managers down here at the conference who are out there, trying to gain AUM, and they're going to the sessions with the hedge fund consultants who are the gatekeepers and trying to say, hey, how do we get more people on board with derivatives? You have a similar challenge, but a lot of it is also you have a large client base potentially there, right there at Northern Trust, who, if you could just explain to them and educate them about options, could probably be very willing to say, hey, I wouldn't mind in an environment like right now, I wouldn't mind hedging some of that downside, right? So walk us through that. How interesting, how challenging has that been to get, a non-traditional options audience? Obviously, you have still a pretty small team, so it's a big lift for you guys to educate that entire client base. But
sure.
How much of a challenge has that been for you guys to try to get that audience up to speed on what you're doing and just educate them on what you can offer from an options perspective to the existing Northern Trust clientele?
Sure. No, it's a great question. So we're, formally speaking, we've been in this business for 6 years. We are really, it's been a grassroots effort by and large. And so what we do is we go out across the world and talk about just true bottoms up ways to add value to your portfolio, ways to think about option-based strategies, whether it's simple or complex solutions, just a different way to express themes, whether it's simple yield enhancement or straight downside protection. But you'd be surprised kind of like how the momentum has grown, both with our internal audience at Northern and with just other client referrals, that it's really starting to gain some momentum to really get some top-down buy-in support at this point.
weeks like this, I'm sure, don't hurt. Everyone I talk to who is out there in the options outreach side of the fence said, this is the week people pick up the phone when you call, right?
Indeed.
Or they call you back.
We had 4 people coming this year to represent Northern at RMC, and only 2 of us made it. So there's definitely some demand to be able to have some seats in the desk.
I like to hear that. I like to hear the growth of options story. Well, John, I'm glad we can get you back on to see what's cooking in the land of Northern options. We'll have to do it more frequently than once every whatever it's been a year or so, and we'll have to check in and see how things continue to grow over there in the land of options at Northern Trust, sir.
Indeed, Mark. Thank you very much.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.